We are discussing on different the alternative source of finance in corporate lending, corporate market. So last week we discussed three items. We discussed syndicate loans. We discussed this commercial papers, and we discussed venture capital, the known major the products in the market. Right. So have you gone through that? Have any doubt and clarification? Let me clear this during this session, right? So again, I have there was a question on the last regarding syndicate loans. So I have prepared a small presentation for that also. I'll give that after finishing of this one. Right. The next product we are going to discuss is corporate bonds. Very familiar one. What is a bond? The corporate bonds are security issued by a corporation or a company, specifically blue chip companies in Sri Lanka, for example. Large corporates can issue what you call corporate bonds. It represents a promise to pay bondholders a fixed sum of money called principal amount of RO face value at a future maturity date, along with periodic payments of interest, we call as coupons. So corporate bonds issued to collect medium-term or long-term funds for a company. Instead of issuing shares without increasing the share capital, when a company needed fixed nature of a capital and borrow issuing bonds. So bond, we call as this is not a what do you call share it's not a share certificate. It's a period for 3 years, 5 years. Normally bonds are issued more than 1 year. So it has a par value and it is given a maturity in the future date. For 2 years or 3 years bonds. In the maturity date, that bond value will be paid back. During that period, bond will be in the face value. During that period, the agreed interest rate will be paid as coupons. Sometimes coupons may pay quarterly, half yearly, or annually, or end of the period. In finance, bond is a debt security. Finance is a debt, it's a loan. Bond is a loan. In other words, it's a credit, borrowing, in which the authorized issuer owes the holders a debt. That means the share issuer is the debtor, and the share bond buyer, the person who buys the bond is the creditor, right? So it's a owes the holder debt, and depending on the terms of the bond, is obliged to pay interest. Call the term you use coupon, and or repay the principal at a later date, or term called maturity. Principal amount will be redeemed on the maturity date. The bond is a formal contract to repay borrowed money with the interest at fixed intervals. Right? When the bonds are put in the market, the investors can buy the bonds from the money market, right? Money market bonds can be, investor can buy, and investors have to pay face value, full value to purchase the bonds. Then, according to the arrangement, the interest can be collected on a agreed period, that is half yearly, quarterly, or annually. So that means interest will be serviced for the bonds, whereas the principal amount will be paid at the maturity. Right? That's called bond. Right? Bonds are issued by the public authorities, credit institutions, companies, and supranational institutions in primary markets. So therefore, bonds are issued to the primary market, that is money market, primary capital market. So not money market, it's a capital market. The capital market, there are dealers called primary dealers. They for them, they will buy the bonds on behalf of sometime directly they buy, or they may buy on behalf of their clients, right? Most common process of issuing bonds is through underwriting. So bonds also sources of collecting funds, credit loans. If the bonds are not sold, the company may not be able to mobilize their funds. Therefore, most of the instances the bonds are issued with underwriting. The underwriting means, we discussed last week also, it is a third party or institution will guarantee if the bonds are not sold, the unpaid bonds will be purchased by the underwriter. Right? It's called, therefore, the subscription for the bonds will be completed. In underwriting, one or more securities companies or banks forming a syndicate by an entire issue of bonds from an issuer and resell them to investors. So this is a money market instrument, it's a money market business. For example, for a company, they put bonds to the market to collect funds for short, medium term, for example, right? Medium term, to increase their share, not the capital amount, that fixed, mostly for purchase of fixed assets, or expansion of business, or buying another company. The bonds can be issued, like what we discussed last week, different purposes. Now, one company can issue bonds to purchase another company, right? So then we calculate, see how long it will take to pay back period, and to cover up the payback period, the company may issue a bond to collect funds for buying that particular buyout of the company, which is the company which are going to sell. And or sometime certain companies that are specifically in the primary market, there are investors, they will buy entire stock, buy the bonds, entire blood they buy. And when the bonds are started issuing, they start paying interest, they resell to the whoever needy investors. So investors can either directly buy the bonds from the issuer, or they can buy the bonds through a primary market, right? So to purchase this entire stock, as we discussed earlier, one bank or a finance organization or consortium of organization, banks and different companies, finance companies get together, they may buy these bonds. And the security firm takes the risk of being unable to sell the issue as the investors, right? That is all underwriter. Underwriter will take on the risk of being unable to sell on issue and to the investors. So they will subscribe the underwriting component of the bond issue, right? Bonds have number of characteristics which you need to be aware. All of these factors play a role of determining the value of the bond. Different type of bonds in the market for different purposes, right? Bond is a debt instrument which the investor loans money to an entity, corporate or a government, that borrows the funds for a defined period of time at a fixed interest rate. So the important part here is the bond, the interest rate is fixed. It will not vary. So sometimes we'll discuss later. Sometimes may be advantage. So bullish market, bearish market is maybe a decent party. So depending on market condition only, the bonds are accepted in the market most of the time. While price bonds is a lottery bond, non-interest bearing security issued by the public. Now, sometimes you may find certain countries issue for the lotteries without giving the entire amount, a bond will be issued. So, on a subsequent or later date, the price winner can get the money from the bond. During that period, he will get interest. That's called the lottery bond, one type of a bond. In Sri Lanka, of course, we don't have that way. Sri Lanka, whenever lotteries are drawn, the entire amount is given to the price holder because funds are available readily. So normally, these price bonds lottery they collect to certain projects, certain projects, right? The bond is debt security in which authorized issuer owes a holder a debt. Right? That authorized issuer owes, he owes the holder a debt. I given loan, it is formal contract to repay borrowed money with interest and fixed interval and plays an important role in mobilizing capital. Now, if a company needed short-term capital for a short term, and what are the sources of funds for a company to collect funds? The main source is issuing shares. Main source is issuing shares. So issue shares, when issuers issue shares by a company, their share capital will be going up, increasing. When the share capital has increased, the company has to maintain their dividend policy. All shareholders, they have to pay dividends. But if a company needs this capital for a shorter period, say for 5 years, after that they don't need to increase this capital. Therefore, if we increase the share capital, which is needed for 5 years, after that they cannot redeem the share. They cannot call back the shares. According to the Companies Act, whenever they issue shares, that will be permanent till the company is closed down. Whether the funds are utilized or not, that is not matter. Therefore, the companies, what they do, they put an instrument like bond into the market and collect funds. And during that period, they earn profits and pay back they build up the interest, what you call pay back the capital amount. Most of the companies, what they do, they collect the capital and annually they build up the capital in a different, build up situation to pay at the end of the period to redeem the bonds. So, end of the 5 years, the bonds will be paid back and no capital has been increased. The company's financial position is strengthened by that because all the investment has been internally increased the wealth of the company. That's not increase liability. The liability part is increased by the way of, not by the way of shares, by the way of other assets. Okay. So the bond is an instrument which can be used for basically collecting of capital, short-term capital. Corporate bonds basics are the corporate bond differ from the common stocks in 3 fundamental ways. The common stock is shares, right? We compare corporate bonds with the shares. What are the difference? There are 3 major characteristics we can identify: the bonds and the shares. Common stock is shares. Corporate bonds represent the creditor's claim on the corporation. That means when we issue a corporate bond, it's a debt instrument. Therefore, the bondholder has the right to claim from the company at the time of a liquidation or any time. They have the first preference they get for that. If investors for the bonds, they get the first preference of payment when the company is going to liquidate. But in the common stocks, like in other words, the shares represent an ownership. So the creditor is ownership. Both are appearing in the balance sheet as a liability, but the type of liability is different. Bonds is a creditor next to equity. Ownership is on the top. The company belongs to the entire assets. After paying the liabilities, entire assets belongs to the owners. That's called ownership. So ownership will be in the top of the balance sheet. Promised cash flows, coupons and principal are stated in advance. In the contract itself, regular interest will be paid, that's called coupons, and principal amount will be paid on maturity date. The date is given in advance in the corporate bonds. When stocks, you don't get that quality. Amount of timing of dividends may change at any time. The quantum of dividend, how much the dividends payment is, cannot be determined in advance. But in the corporate bonds, the investor can have the idea that every quarter he is getting so much amount. So he have a permanent cash flow. He can build up a permanent cash flow based on that. But when he invests in the company, in the shares, how much of dividend can be obtained is not sure. Sometimes if a company make a loss, then there won't be any dividends. But in the corporate bonds, even the company make a loss, the interest has to be maintained. Interest has to be paid. So therefore, when you're investing in a company, either going for a stock or a share purchase or going for a bond purchase. Depend on have to decide depending on the background circumstances. Of course, on the other hand, coupon rates are fixed, therefore they are getting fixed income. On the other hand, dividends may differ depending on the profits. Available of profit, the dividends made year to year may differ. It may go up, it may come down. Mostly callable. Callable means anytime corporate bonds can be paid back. That's a condition applied in the corporate bonds that although issued for 5 years, anytime if the company wants that the company can pay back the capital amount and the balance principal and call back the bonds. Mostly callable. Almost never callable because when the shares are issued, till the company is closed down, it cannot be called. Right? There are certain other common factors also under the both. Even corporate bonds, whenever the creditor needs money, he can sell the bonds in the money market. Secondary market can be sold. Similarly, shares also, if they wanted funds in the investor in the funds, he can sell off his shares and get his money back. So that is common for both even bonds and the shares. Okay. What are the terminology we use in corporate bonds? Face value, the price of the bond when first issued. So, for example, each bond is 100,000 rupees. The face value is printed on the face. It is 100,000. That's a face value. Coupon rate is the periodic interest payment promised to the bondholders at a fixed percentage of bond face value or simply the interest rate. That is just what's the percentage of interest payable for these bonds. It's called coupon rate. Maturity is the time until the principal is scheduled to be prepaid. When the time to be prepaid. In call provisions, some bonds contain provision which enables the issuer to buy the bond back from the bondholder at a pre-specified price. Call provision speed, sometimes when the bonds are issued, there can be a condition that a provision can be made that any time, although issued for a certain period, for example, 5 years, before 5 years, issuer can recall the bonds at a pre-specified price. If they recall, something little more has to be paid, not the face value, more than it has to be paid. Excuse me. Yes, sir. Yeah. Okay. Okay, I'll see. I'll see it. Okay. Okay, I'll see it. I'll see it. Yes. Sorry. Okay. So it says if there are provision in the bond issue, right, then at what rate it will be called back? 10% above the face value, 5% above the face value. Likewise, can issue, but it is not the bondholder may pay back or may hold it as according to the conditions. He can sometimes hold back till the maturity. And the other one is put provision. Some bonds contain provision due to which the buyer can sell the bond at a pre-specified price before it is maturity date. This vice versa. All provision means issuer put the condition that he will cancel, call back the bond at any time before the maturity. Put provision means bonds are issued that the buyer, bondholder, put a condition that he will sell back to the issuer at any time before maturity date. Now, these two are very important to understand. This is the contract between the issuer and the bondholder, buyer. It doesn't mean that the bondholder right to sell the bonds in the call money market. It is different. Right? Whenever funds you need them, bond can be put in the market and sold and collect the funds. Similarly, if a person having a bonds, he can mortgage a bond to a financial institution and borrow some money against that. Right? So bond is again an instrument which can be negotiated. And also it can be kept as a security collateral and borrow from a bank or a financial institution. Right? So it's a very vital important instrument. What are the types of bonds? Bonds are securities that represent debt owed by the issuer to the investor and typically have specified payment with specified date. For discuss, we are summarizing again. It's a debt instrument by the issuer. Investor have right to invest for get a specific payment of a coupon on specific dates. Types of bonds in examine including long-term government bonds, that's called treasury bonds, municipal bonds, and corporate bonds. Now these are large organizations. You can see these three bodies who are issuing these bonds. The countries are large organizations. The government always issued treasury bonds. Right? They're very common. Every 3 months, treasury will issue bonds to it may be from 3 months to 5 years. Right? T-bills are issued for shorter term. Treasury bonds are issued for long term. We give a long term, 3-year bond. And also, treasury bond can be issued as sovereign bonds. Sovereign bond means it can be sold in the international market or in It can be sold in foreign currency, and whenever needed foreign currency, government can put sovereign bonds, and the other countries will buy the sovereign bonds of that country and invest their funds in the states. That's called government bonds, not T-bonds or treasury bonds. Municipal bonds in Sri Lanka we don't find, but other large countries, the separate states are there. For example, if you take India, they have different states. Pakistan, number of states are there. Sindh state and Madhya Pradesh, Karnataka Pradesh, like that. Different state, internal states are there. So whenever they wanted to raise their funds, they will issue municipal bonds. They call municipal bonds issued by a municipal council. They are called municipal bonds. Corporate bonds are, as we discussed earlier, it is the public corporates, public business organizations. They put bonds into the market. So this is a type of a simple, what you call, sample of a bond. You can see the specimen. The value is given. This is not in Sri Lanka. It's actually I got from Philippines. What type of corporate, how the corporate bonds look like? It's a certificate. It's a certificate, right? It has a fixed interest rate. You can see there, and the number is given, value is given, and only the write down the name person. It is open. It's like open paper, right? So normally bonds are issued. We said what are types of bonds? The government of corporation, that called T bonds, treasury bonds, specific period, interest rate, applied return at the maturity date. Treasury bonds issued by the government to finance the deficit. Now you would have seen every 3 months, you look at the central bank report, all the newspapers, that our treasury, all the central bank, put into the market bonds, right? So there are bidders, they will be done by these bonds at a certain interest rate. So the lowest interest rate, the treasury bonds may be sold. Right? You know what happened to our bond scam last time. It is not the lowest price, it's the highest price that has been bought. So it was a loss. That's what we call bond scam. These treasury bonds issued by the governments, it is a sovereign bond, it can be bought by other countries. Now, for example, Sri Lanka, I think it is in 2003 or 2004, Sri Lanka had bought Greek treasury bonds. Which lost ultimately. Everybody knows that situation. It's a sovereign bond. Greece was, and the situation was not good. They put in the market some bonds. Sri Lanka had to invest our money in Greek. Right? So we lost entire thing. So we had before invest, we had to see background now. For example, Sri Lanka, now we are finding a difficulty situation in government. We are finding connection. We don't have funds. So they are seeing there are other news is going on, and most of them are not in the public, media. This is mostly social media. You may find that discussions and these things are going by expert. And how much of funds we are having, and to increase that, we can issue bonds and collect some funds. The problem is to issue bonds to the public or international market. The government should have the country should have a good rating. At the moment, Sri Lanka, our rating has come down. Our rating has come down from B minus to C. That means we are in a weak situation. So, such a situation, No one will come and invest. No one will come and invest. If anybody want to invest in that manner, if the country is in a risk situation, no one is going to risk their money. Only it should be backed by a strong collateral. That's what's happening in Sri Lanka now. Strong collateral. I'll come to next session. You will have seen how it has this is moving. Anyway, so the public corporate bonds issued by the corporations or companies, there's a high risk because of a company's defaulting. The bonds are issued for a longer period. It's a short period. Bonds are issued for a longer period. Therefore, as a high risk, the future performance of a company is a high risk. So investing in bonds or long-term capital is a high risk. It's a high risk. So therefore, that's what I told you earlier. To develop these type of products, instrument in the country, we should have a strong financial hub. Financial hub. I told you that last week also. In 1979, Sajja Jawatana wanted to convert Sri Lanka into a financial hub in Asia, like Singapore and Malaysia. Before Malaysia came to this stage, in Singapore and Hong Kong were the two strong financial markets in Asia. To carry out this operation of making financial hub, to strengthen the financial system, there are 10 foreign banks came to Sri Lanka. Indus Bank, BCCI, it's called another Netherlands Bank, is a Netherlands Bank, Bank of America. They came to Sri Lanka. They established this financial hub. So it's established a good market. In 1980s, if you look at our history, our companies have been issuing these type of products, bonds in the market. These products are somewhat becoming popular, but everything went wrong after 1983 riots. Entire economy, of course, other side fallen back, and we lost that trend completely. We lost. Still, we could not build that due to the number of reasons. Okay. So the corporate bonds are issued by the public companies. Public companies. It is public means the other shares are issued in the public. Those are registered in the security exchange. They are called blue chip companies by us. Our terminology is called corporates. They are the people who issue mostly the bonds. The other one is convertible bond. This bond can be converted into a certain number of shares of the same company, some fixed ratio in a particular date. Now, when a person or investor invests in a company, anticipating to convert that into the shares in some time later, if that provision is given in the bonds, after some time, the company may convert that bond into shares. Right? And that's a similar product. After this, I'll explain you what is that product. Right? So bonds can be converted into a number of shares. That means the capital amount can be converted into shares and certain grades. Most of the instances, when the capital, we say for 100,000 worth of bond, right? Now, when it converts into shares, the shares will be sold. Shares can be sold at a higher price with a dividend, right? At a higher price, called not a discounted price, it's a dividend price. For example, 10 rupees share can be sold as 15 rupees or 20 rupees. So if the investors are willing to buy, because his face value may become low, he is losing, but in the long term he may gaining and getting the ownership of the company. From the data convert into a ownership. That's called convertible bonds. Then callable bonds, certain provision that gives the issuer right to call back the bond before its maturity. We just discussed it a while ago. Then secured bonds have specific assets issued which as collateral for the bond. The bond can be secured by real estate or other assets. Now, this is somewhat popular item. Issue bonds attached to or is collateralized. Otherwise, it's collateralized. Certain specific collaterals are attached to that bond. Right? So bonds are issued. It has been backed by more that will give assurance that certain assets of the company will be assigned to that bond. In the case of a default, so assets can be sold and pay back the bonds if a company defaults. So those are called secured bonds or collateralized bonds. Unsecured bonds are no very normal. Normally, presently, or the common issue is unsecured bonds. Those are not secured by any specific collateral. Very easily, if the company's financial position is sound, if it's having a good rating, these unsecured bonds can be sold. Most of the instances, unsecured bonds are going for a comparatively shorter period, not longer period, comparatively shorter period. The government bonds we already discussed, it is known as risk-free bonds because the guarantee given by the government is called guarantee bonds. That's called treasury bonds. We call this as treasury bonds in Sri Lanka. These are risk-free bonds. There's no default risk. Government is giving the security, and when it issued foreign currency, it is referred as sovereign bond. And when the current bonds are issued locally in rupees, it is called T bonds, just treasury bonds. When the bonds are issued in foreign currency, in dollars or euro or pounds, sterling pounds, it's called sovereign bonds. So government, when they were foreign currency, they issued sovereign bonds. Okay. And the other one, term bonds, maturity term, single specified future date. That will be on a specific date, the bond will get matured. Then serial bonds mature in installments. That means sometimes the bond is issued for 5 years. Every annually, for example, installment base is getting matured. Right? For example, issue for 5 years. After 3 years, that will be a part of that will be getting matured. For example, 25% of the bond value will be matured and released. Then, after another 2 years, another 25% of the bonds may be released. Right? And these are called serial bonds. Serial bonds are issued to companies to get reduce their liabilities in the long term. Okay. When inflation-linked bond is provide protection against inflation, designed to cut out the inflation risk of an investment. Now we know that due to an the inflation, the face value of an investment may get either increase or decrease. Right? Most of the time we find that value of the investment deteriorating over a period of time because of the inflation. So due to the inflation, sometimes you may find that the inflation will be discounted in these bonds. In issue bond issue, the inflation is adjusted with the what you call adjustment rate. Now, normally we apply for this NPV technique, net present value technique, right? What is the net present value of this bond on 3 years time with the inflation rate of 5%? So that will be the inflation increase in inflation, and if the inflation increase 5%, so that will be adjusted accordingly that inflation, and when you say going to pay back, the risk part has been absorbed by the issue. So that is more what you call attractive than normal bonds, right? So that means that they are already their real value of the money will be always they are getting back at the time of maturity. It's called inflation-linked bond. In extendable bonds or retractable bonds have no fixed maturity date. Extendable can be extended on demand of buyer, while retractable date only can be reduced. Right? This is what you call some sort of a flexible type of bonds. It can be extended to maturity. There's no maturity date. So whenever the buyer wanted to get it matured, he can tell on this date it can be this bond has to be matured. So the issuer has to pay back the money on that date. So these are risky to the issuers because there's no always effect in their cash flows. Well, then zero coupon bonds, a type of bond that makes no coupon payment but instead of issuing considerable discount of par value. That was bond value 100, par value 600, 10 years maturity. The coupon bonds are discussed where interest is paid in between. Right? Your 10-year bond, every 3 months, at the rate of so much, interest is paid. It's called a coupon. It's a coupon bond. Zero coupon bond means issuing the bond with a discount. For example, you given here the $1,000 par value, and it is issued at the rate of $600 for 10 years. So at the end of the 10th year, the investor who invests $600 can get back the capital and the principal amount as $1,000 end of the period, 10th year. That's called zero coupon bonds. These are normally zero coupon bonds are calculated as mentioned earlier, taking into consideration compound interest, the compound interest rate. You are paying $600 today for bond worth of 10,000 in 10 years. Longer the maturity, lesser would be the issue price, vice versa. Apart from the benefit of investment in bonds, there are also some risks subject to bonds, such as inflation risk, interest rate risk, foreign risk, and callback risk. Inflation risk, we know that. Due to the inflation, real value of money getting deteriorated. Interest rate may fluctuate over a period of time. It can go up, it can come down depending on the market condition. Foreign exchange also depending on the demand and supply of foreign exchange over a period of time, it may change. So that risk has to be borne by the issuer as well as the buyer. Mostly buyer has to pay for it. Okay, I just mentioned to you about it a while ago. There are certain similar products are there in relation to the bonds. Now, in Sri Lanka, we don't have that. India and other countries, we got a product called preference shares. You heard about that, no? There's a product called preference shares. Preference shares also is some type of a shares, and it has a fixed amount of dividends. And this preference shares can be redeemed. For example, 10-year redeemable preference shares means end of the 10th year, those shares will be redeemed back. That the preference shares will be released. I told you earlier that whenever we are releasing shares, redeeming the shares, the issued capital cannot be changed, reduced. Issued capital can be increased with the registered capital within that, but it cannot be reduced. So therefore, what happens? Most of the instances, the companies will issue ordinary shares to redeem the preference shares. So the shares will be the same value. It will be changed the form of the shares. So likewise, bonds also can be converted into shares, right? But it doesn't have any impact on the issued value of shares. Has no impact. But it can be redeemed later on. It cannot be redeemed later on because when you increase the shares, you cannot reduce without a so without the approval of the under the Companies Act. So entire shareholders has to pass a resolution and try to reduce the shares. Okay, so that's about the corporate bonds, and right. Okay, then we'll go to another product similar to these corporate bonds. Is can you see? Hello, can you see this? Yes. It's okay, no? Right. The next time we should. Hello? Right. Now we call another instrument called debentures. The word is very common for among us. They are the ones. Debentures also some sort of a type of a long-term or medium-term debt instrument. In corporate finance, a debenture is a medium to long-term debt instrument used by large companies to borrow money at a fixed rate of interest. Similarly, bonds, debentures also is a medium to long-term financial instrument. Debentures are locked amount and convert into an instrument put into the market, money market, as capital market mostly, the capital market is put into. Then there will be buyers who will buy the debentures and invest in that company. It's an investment instrument. The legal term debenture origin referred to a document that either creates a debt or acknowledges it. But in some countries, the term is now used for interchangeable with the bond, loan, stock, or note. Right? Mostly, it is actually it's a debt instrument. It is something more very commonly closely related, similar to the bonds. Debentures are the features are a little different than a bond, but more or less same. Right? The debenture is a document issued by a company under its seal to subscribers to debenture capital of the company. Right. Whenever a company need capital, investment in capital, without issuing shares, without increasing the shares, they can borrow from the market. Now, borrowing, what are the borrowing instrument? We discuss in the intermediary, financial intermediation, that is through a bank, banking products, or disintermediation. Disintermediation, bypassing the bank, going direct to the market and collecting funds. So debenture is another instrument where directly mobilizing funds from the market. You put into the market, advertise in the security exchange, get the proof of security exchange, issue the debentures. Normally for blue chip companies which are registered in the security exchange can issue debentures. It's a document that acknowledges the debt owed to the subscriber by the company. Again, it's a instrument of acknowledgement of a debt. Instrument which has acknowledging the debt. It's a borrowed money. In other words, this is loan capital. In other words, in simple terms, debentures, bonds, corporate bonds are long-term borrowings, long-term loans. But the method of issuing the methodology is little different. Okay? Debentures are securities documents issued by the company, like share certificate issued by the company, having a face value. Right? 1 million or 100,000 rupees face value each debenture. But it's important to understand that while share certificate is issued to subscribers of the share capital, which equity of the company, while debenture certificates are issued by the company to subscribers to debt capital of the company. Right? There's a difference between the share capital and the debentures like we discussed in the corporate bonds. Debenture is issued to the debt capital. That means capital is increased by the way of debt borrowing, long-term borrowing. Okay. Share capital being equity is not returned, while the debenture capital being debt is returned or returnable by the company. So debentures are on the maturity date, it can be redeemed. It has to be redeemed. That means share capital, I told you earlier also, share capital cannot be returned back. It has to be under the Companies Act. You can't reduce the share capital. So if you need a share capital for long term, so 5 to 10 years, the company can issue debentures or corporate bonds. Right? So debenture again is a loan instrument, a debt instrument. That means a witness of the company's owed to certain person who is the debenture holder. While shareholders get returns called dividend with no limits on the rate. The dividend I told earlier also, there's no fixed amount, fixed rate, depending on the amount of shares and the amount of profit earned, the dividend may change. But even at the discretion of the company management, the debenture holders get a fixed rate of return in form of interest. So debenture holders, interest rate is fixed, right, throughout the period. It is compulsory on the company to pay the interest whether there is a profit or loss. Like bonds, same, debenture same. Whether company makes a profit or not, interest has to be serviced. Interest has to be paid. In fact, interest paid is a charge on the profit, meaning it is a business expense. Right? Debenture interest is shown as expenditure in the P&L under the financial cost. Okay? While dividend being a distribution of profit, not charging the profit of the company. It's paid by profits, not an expense. That's why normally when you analyze a profit and loss account, you may find three sorts: operational profit, profit before dividends and tax, profit after dividends and tax. So dividends and taxes are not part of the expenses, not part of the expenses of the company. That's why they are shown separately. Okay. A debenture is thus like a certificate of loan or a loan bond, evidence in the fact that the company is liable to pay a specified amount with interest. The debenture holder is it's a loan amount loan given to the company. So whenever a company is under liquidation, the first preference goes to the debenture holders. The loan amount has to be paid. The borrowings has to be settled first. The debentures has to be settled first before going to shareholders. Right? So it's an evidence of the facts liable to specific amount. Although the money raised by the debentures become part of the company's capital structure, it does not become a share capital. So normally debentures are issued to invest in raising long-term assets. Most of the companies, whenever they wanted to raise long-term capital, they raise debentures. Right? Now, very important fact we have to discuss why customers go for debentures. Although debenture is a disintermediary instrument. If, for example, a customer of a bank or a finance institution want to go for a construction, commercial construction, multi-story building, it needs a large capital amount. Now, if it is going through the bank, what are the advantages and what are the disadvantages? So, now it has to be mortgaged, the property has to be mortgaged to the bank. Okay. Secondly, there's a big cost, huge cost on raising that loan. That is a legal cost, valuation cost, registration document, stamp duty, huge amount of cost has to be incurred. Thirdly, the bank may give a what do you call grace period to construct the building. Although the construction has completed or not, on the due date, bank will start recovering the installment. Bank will start recovering the installments. So what will happen? The customer has to pay back the installment even though the project has not generated any income. So if you go to disintermediary instrument, debentures, it is raised from the outside, in the public market. Right? So debenture interest will be annually is paid according to agreement or like bond. The money has not to necessarily be paid back till the project is completed. For example, debenture issued for 10 years. Before 10 years, debentures may not need to pay back. It can pay entire amount in block on the maturity. So there's a benefit to the borrower. On the other hand, the cost of fund is much lower. Mostly we are going for this type of disintermediary instrument, less than the bank interest rate. Right? There are debentures, two types of debentures are there in the market. One called senior debenture, get paid before subordinate debentures. And there are varying rates of risk and pay of these categories. Senior debentures mean that is that they are getting the priority and when they were giving settlement of this debenture, they are getting the priority. Subordinate debentures before they, it's like priority is given for senior debentures. So what are the okay? So what is a debenture? It's a debt instrument. It's a debt instrument issued to the money market, collecting debts straight from the money market. So this intermediary instrument. It has a benefit because it is cheaper than bank loan. The interest rates are very much less. And repayment period can be extended according to the price of the tenor is increasing, the interest rate also increasing. But when you work out the NPV, sometimes much benefit than the bank loan. Okay. What are the types of debentures available in the market? The debenture classification depends on their redemption, maturity, convertibility, security, redemption method, interest rate, coupon rate, and performance. Depending on the number of factors. What are these factors? On redemption, whether redemption rate, maturity, or convertibility. Security is redemption prior to the retirement. Interest rate and the coupon rate and performance. First type of debentures we call secured debentures and unsecured debentures. Secured debentures are debentures that are secured against the assets of the company. And if there is any default on repayment of such debenture, then asset is charged against that. It's like a mortgage. Right? Secured means certain assets of the company will be charged against the debenture. So debenture is backed by an asset mortgage. That's called secured debenture. Right? In the bond market also we found that. Collateral price debenture bonds. Then unsecured debentures do not guarantee any charges neither against the assets of the company nor are fixed or floating. The assets are not attached. These debentures are little high risk to the buyers and it carries higher interest rates normally than the secured debentures, right? Then convertible and non-convertible debentures. Convertible debentures can be converted into equity shares at option of the debenture holder. After a certain time interval, he may convert his shares into equity shares and become shareholder. Like bond also we found that same features were there. Debentures also can be converted. After some time, for example, after 5 years, for example, you should have debentures issued for 10 years. After 5 years, option can be given to the debenture holder to convert his debenture into shares, equity shares. That's called convertible debentures. It can be converted into shares so after some time. Then non-convertible means debentures are most common types of debentures which do not have an option to convert shares or equity in kind. These debentures will last until they are mature. Right? This debenture unconvertible mean if you put the issue or condition which is unconvertible, the debentures will be there till it is maturity. So the investors has to wait, hold it till it getting matured. It will get matured. Okay. So these are called types of debentures available in the market. The other one is redeemable or irredeemable debentures. Redeemable debentures are issued at the end of its term issued at the end of its term. This means that at the end of a certain period, they will be paid in the installment in one or other in a lump sum. Such debentures can be redeemed at premium or discount. Now, for example, the debenture issued for 10 years, if it's redeemable debentures, it can be redeemed prior to that. So there can be a minimum period. After 3 years or 5 years, it can be redeemed. And that option is given to the bond or the debenture holder, whether to redeem or not. Right? Such debentures can be redeemed at premium or discount, depending on the company's wealth, value, the payment, financial strength. It can be discount or premium. Premium means the debentures will redeem at a higher rate than the face value. At a discount rate means debentures are paid lower than the face value. Irredeemable debentures are permanent ones. There is no fixed date to pay them. It's a lifetime like. They can be rescued as a company goes into liquidation process, or they can be retrieved after unspecified long intervals. Irredeemable debentures normally not popular item because it's at a high, very high risk. It is till the company liquidate, the debentures will go. During that time, the investor getting a fixed interest on that debentures. That is not more popular, attractive, irredeemable debentures, although impact in the market is there. It is quite often this type of debentures are issued with a what do you call it? With assigning of companies' interest on the last date. A certain percentage of assets also can be given for these debenture holders till who were holding their debentures till last. Or else they can fall back. Debentures also an instrument. So debenture also an instrument. It can be negotiated. A debenture holder can sell his debentures in the market, in the secondary market. Right? Money market, they can put debentures into market and sell if there's buyers at premium or a discount. Also, debenture holders can get loans from the banks and other financial institutions, mortgaging the debentures. Keeping the debentures as a collateral and borrow from the banks. So when the banks getting debentures as a collateral, it's like a near cash instrument. Most important thing is just if I see whether the company issuer has a good credit background, a sound financial background. That has to be verified. Okay. A debenture acknowledges a debt that usually shows the amount and date of repayment. If you summarize what we discussed about debentures, the features of debentures, right? This is the nutshell what we discussed in the earlier slides. Right? Executive summary. The debenture acknowledges a debt that usually shows the amount and date of repayment of a loan. Right? That is the debenture document instrument. It acknowledges the debt by the issuer and also when they are going to pay back the money and what is the repayment plan. Interest payable on debenture is charged against the profit and hence it's a tax deductible expenditure. In other words, it's a loan. It's a borrowing, like a bank loan. Method of borrowing is different. Instrument is different. But that is a financial expenditure. So it's a financial expenditure can be debited to P&L and it is tax deductible expenditure. So one advantage getting debenture like any other instrument is that. Then interest on debenture is payable even if there's a loss. It's an agreed term. If the company, issuer company make a loss, even debenture interest has to be paid. A debenture holder may either repay the debt or even convert the debenture into shares or other debentures. So that the option is there to collect the funds or convert that into a shares or invest in further any other debentures. Okay. Debentures are evidence of debt that shows that the company owes a debt to a debenture holder. They may or may not carry a charge on the company's asset. So it can be collateralized or free of charge. That means asset back or not. Debentures are generally transferable. A debenture holder can sell them on a stock exchange at any price. And debenture holders do not enjoy any voting rights because they are not, although they provide equity to a company, they are not shareholders. Debenture holders providing equity to the company, but they are not getting voting rights because debenture is not a share. And debentures are transferable, and it's mentioned, it's a transferable instrument. Okay. Right. How to issue the debentures? What are the procedure? Like shares, debentures can be issued at par, discount, or at premium, depending on the financial strength of the issuer. It can be issued at par value or a discount lesser than the face value or at a premium. That depending on the financial strength of the issuer. Discount is loss while premiums are profit to the company issuing the debentures. If the debentures has to be issued at a discount, it's a loss to the issuing company. But if you issue at a premium, the premium is a profit to the company issuing the debentures. Why a company issue debentures at a discount? Why the company is issuing debentures at a discount? Because they need the finance urgently, but companies' current performance may not give any favorable backing for such debenture issue. So discount is an attraction those who have want to invest. And such instances, the debenture issue has to show future prospects of the project. Future prospect of the project to attract the investors. At the time of redemption, also it can be at par, discount, or premium. It can be redemption at par value or discounted or premium value. Normally, we need interest is serviced regularly. If the debentures are operated in a normal way and it is company does not have any negative impact about this maintain their finance, then they can redeem the debentures at a discount. But if the company shows any negative sign, then redemption has to go for premium. But remember, discount and the redemption is a gain or a profit to the company and premium is a loss to the company. This is what we have to understand. The accounting concept of the conservation says a loss at the time of redemption must be accounted in the time of issue, along with the lost profit on the issue of the debenture. This is accounting principle that if it is a loss, it has to be shown. Redemption loss, it has to be shown in the profit and loss account. So premium at the time of redemption, a loss must be accounted in the books at the time of issue of debentures. As a premium, it's not necessary to show, but at a loss, it has to be shown. But discount at the time of redemption being a profit will not be accounted for books in the accounts. Right? Redemption profit will not show in the books of the issuer's books. These are accounting principles, accounting terms, issuing debentures. Okay, so that's all relating to debentures. So now, mostly if you compare two products, these debentures and corporate bonds, you can see that both products have a similar nature, similar features, similar products. Why these two products? Now, earlier debentures were some of the popular products issued. But over a period of time, the bonds are take over in the debentures. Now, debentures are not that much of popular in the market, but the bonds are comparatively popular in the market. Whatever instrument what we discussed now up to now, with regarding to this intermediary instrument, that is commercial papers, corporate bonds, debentures, are disintermediary instruments. That means they are overriding banking sector to collect the funds from the money market. Okay, so to popular these products, these products, there should be a very good, very strong financial market in the country. Since there's no developed financial market in the country, you may find very rarely a company may come out with this product to the market. Right? Economic strength, stability, and the market stability are some of the factors which establish the money market, the short term and the long term. Okay. Well, so these instruments are we call corporate instrument. Normally are used by the large blue chip companies to collect their funds whenever they want it. The recent bond issue was, I think, not in the near, very close to history. Last one was, I can't remember exactly. So, therefore, mostly what happens, almost all the companies are now depending on the intermediary issues. Now the time has come to go out of this scenario, because the banks also get involved in the the investment of this in the issues. So for example, if a company is issuing debentures, the bank can purchase the debentures on the market. That's what you call investment opportunity. If the company is good, future is good, project is viable, then you can buy debentures. So whenever they want from difficulties, they can put it in the market and sell. The bank is finding liquidity problem, put it in the market and sell and collect funds. So these instruments are very commonly can be used. Even any financial institution, although they are not issuers, they can get the benefit of this instrument when it's put in the market. Okay, so that's all related to the debentures. Any questions? Okay. Now let's go for another uh, another product in the market. Now this is one of the product that now currently we are discussing. It's called asset-backed securities, ABS. Now this is not a new concept. It was some time back, about 15 years back. This concept was came. Again, large financial markets. These type of products are very popular. Still, in Sri Lanka, we are lacking to come back to this type of situations. Still, we are depending on mostly conventional method of financing. What ABS drive their cash flows from pool of underlying assets. Asset-backed securities mean one is mortgage-backed securities. Secondly, certificates of automobile receivables. Now this terminology, don't worry about the terminology. These are Indian terminologies mostly, or commonly used in other countries. I explain what are these things. Third one, certificates for amortizing revolving debts and home equity loan securities. And what are these items? Asset-based securities derive their cash flows from a pool of underlying assets. Now, what are these assets? Mortgages, mortgage-backed securities. Any fixed asset, if bank is granting a facility, bank or a financial institution granting a facility, loan, credit facility, we take tangible securities. What are these tangible securities? Stock in trade, motor vehicles, machinery, and immovable properties. These are movables, last one is immovable. So these are called tangible securities. All these tangible securities, when we take as a collateral, it will be charged to the lending institution. It will be charged to the lending institution. The charge document is called mortgage. The charge document is called mortgage. It's governed by, in Sri Lanka, Mortgage Act. Right? Governed by Mortgage Act, 1942. And there are subsequent amendments. Now, that is one of the assets in our books. Banks, the financial institutions, balance sheets, we have got mortgage loans. Loan is a receivable, and it is showing in the as asset. Secondly, certificates for automobile receivables. Mostly this is for leasing facilities. Receivables. Automobile receivables mean lease rentals. Lease rental from automobile lease, that is vehicle lease. Receivables, future receiving It's asset. Receivable is asset. Then certification, amortizing revolving debts. Right? Whatever receiving, amortizing revolving debts, every month we recover an installment. Right? We recover installment from the customers. All loans. Now we can remove these two out. Other than the mortgage, other than the rentals, there are other loans. Our receivings are there. Right? Other receivings are there. But receivings also, accounting payments is an asset. Receivable is an asset. For example, if we grant a facility to a customer, we work out installment plan. Scheduling other money, such and such a date, such and such amount, customer has to pay, and it is receivable to the bank. Capital interest. Future receivings. So we work out our cash flow, bank's cash flow, based on how much of amount we will be receiving next month. Month after next, third, fourth, like that. Every month how much we should receive. So we plan to invest those money today by beginning. We plan out that money to be lent. That's called amortizing revolving debts. ඉස්සරහට ලැබෙන තියෙද දැම්ම අපි කස්ටමර්ස්ට දෙන්න වරොන්දු වෙනවා. Because customer, we are not releasing the funds immediately. Today we grant a facility, we facility grant करना है today we giving a facility to the customer, and it will be released on installments. So those installments are releasing based on the receivable from the other loans. You can match करना. Okay. Branch again you can but at head office level will do that. It's called revolving debt. Then home equity loans equals mean housing loans. It's a long-term facilities. Long-term facilities and equity loan is loan installment equity. Every month they are getting installment. Now these are our bank's assets. Some of these assets we invest to earn profit. Some of these assets are idling in our books. Some of these items are idling in our books. Now that's what we are going to talk about now, these asset-backed securities. The underlying assets generate cash flows of principal and interest, which can be repacked and sold to investors. Principal interest. මේ දෙක මාස් පතක් කොච්චරක් අපේ receivable එනවද කියන එක අපි cash flow එක bank එකේ හදුවම we know that it has been for. So it is fixed income from our assets. What is our asset? Loan portfolio is an asset in our balance sheet. From that asset, we are generate income, fixed income, by the way of principal and interest. Principal amount of repayment of the loan installment, interest will be the income generated from that business. So that's a cash flow. Underlying asset generate cash flows of principal and interest, which can be repacked and sold to investors. So this fixed income and asset, so what can be given to another borrower as a loan. This is what our business is. To lend, this is one of our source of funds. Loan installment. Whatever loan installment comes, repackaged and sold to investors. That probable borrowers, we give that. So we current as well as future receivables also take into consideration while when we are going to do this packaging. Right? So these are called asset-backed securities. Right? Now we run this repackaging the facility. We repackaging this security, you can see, called asset-backed securities. We give a loan to the customer. We give a loan to the customer backed by principal and interest, which is receivable in the future. It's called asset-backed securities. Although this practically is happening, it has formulated as a new instrument or new thing in the recent past. It was happening. Now, earlier, when we discuss about these lending principles, what are the sources of funds? Equity funds, loan funds, customer deposits. Third one, fourth one is most important is loan recoveries. And fifth one is the undistributed profit, retained profit. So these are 5 sources of funds available for us to bank or lending institution to grant facilities. The source of funds. So this, whatever internal company, internal receivables are source of funds. Now that is, we have taken out separately and discussing now as a concept. That's what we are doing. Right? We were doing earlier. So the more you do this, it's a cycling process. The more you turn over the cycle, the pool, every month loan and installment will be given as loans, and our loan portfolio will be expanding over a period of time. This is what we are doing now. It's called asset-backed securities. Okay. Right. Now this concept further developed මේ concept එක තවදුරට develop කරලා ඉස්සරහට we are talking about debt securitization කියලා concept එකක් we are going to talk about. Debt securitization. That's based on this asset-backed securities. Okay, so all our assets we discussed this. Mortgage-backed securities, automobile receivables, amortization revolving, and equity. All these loan installments, the cash flows coming from these sources, we pool into one asset and lend into the customer. It's called asset-backed securities. The cash flows from all the facilities. In other words, loan installment and interest from the mortgage certificate, all different type of our advances. We are getting a cash flow. That cash flow will be invested back. It's called as a pool into one basket, and that will be given to the borrowers or investors. That's called asset-backed securities. Okay, right. So this principle will go ahead with the concept on the other one, securitization. Okay. Now, little complex situation, little complex products we are going to discuss. Any question about these asset-backed securities? Any clarifications? You clearly understood? It's clear? No one is answering.
Sir, can you
Yes.
say cards? Can you
Hello?
can you explain the cards again?
I can't hear you.
Can you explain the cards?
Which part?
Asset-backed securities, the cards.
Mortgage, ABS, that part.
Yeah. ABS cards. Uh,
Okay, I'll get back to the slide 1 minute. You are referring to this one now?
yes, sir. That's one. The third one.
Cards, certificate for amortizing revolving debts.
Yes.
That's one, no? Right. That is, what is amortizing? Loan recovery. Okay. So loan recoveries other than the mortgage-backed loans, certificate, what do you call lease rentals, automobile receivables, lease rentals, and finally home loans, right? Long-term home loans. Other than that, normal general loans are there, no? Your business loans, then import-export trade. Those are revolving debts. That mean revolving mean the debts are revolving. There's a limit given and revolving. The moment of revolving, now for example, if you take a permanent overdraft, why we are giving a permanent overdraft to customer? It is should to revolve. No, it's for working capital revolving. So customer has to revolve that facility. While it is revolving, the cash flow is generated. No? Whenever he revolves that facility, it is not fixed. It's not blocked. The revolving part is called amortization. So that's debt will be revolving and it is creating a cash flow. Right? Loan installment is blocked. We are giving a loan is blocked. When you give an overdraft facility or an LC facility, it is revolving. Once he pays off, another new one is taking off. It pays off, another one is taking off. So that amortization is revolving. That revolving creates a cash flow. Understood?
Okay, sir. Okay.
Right? Now, for example, we say we are given a customer limit of we say 100,000. For example, the customer is utilizing 60,000 out of that, and again using paying back 10,000, and again utilizing 20,000. Within that 100,000 is revolving the facility. Okay. So the amount of revolving, that means that is money is available at any time for as a cash flow. Up to 1 million, it is available to the cash flow. That customer can utilize that money at any time. So that cash flow is what we are using as a pool to pool. That's what called amortization revolving debts. Okay?
Okay, sir.
Okay.
Okay, thank you.
Any other clarifications like this? No, these are new concept. Actually, it's not a new actually, but for us it's a new concept. It will take a long time for us to absorb these things into our system. Okay. Then we'll get back to the asset-backed securities or called debt securitization. This is what you call debt securitization. Now, asset-backed securities are one of the instrument for debt securitization. Debt securitization. Now, we are going to talk about this, what is debt securitization and how the debt securitization is used in our financial markets. Okay, shall we have a small break? We can complex maker. We concept about complex value. Okay, so we'll have a small break and about 50 minutes. We'll come back at 3:30. Continue. Okay, let's go for debt securitization or securitization. There are different terminology are using. Securitization, debt securitization, then asset-backed securities. Another terminology is securitization. Yes, the securitization means it stands for conversion of loans or loan recoveries into marketable paper or securities by SPV. Now, what is this SPV? Very common term nowadays. What is SPV? Special purpose vehicle, right? It is not automobile. It's a what you call it's not an instrument, but a organization, some sort of a body, organization or body. It's called SPV, special purpose vehicle. This terminology is that. Now, stand for conversion of loans or loan recoveries into marketable paper or securities by a special purpose vehicle. By pooling of assets, it diversifies and reduces risk of the portfolio, and with additional credit enhancement arrangement can produce highly creditworthy instrument to the market. Now, what little while ago we discussed ABS, asset-backed securities. What we discussed there, pooling of all the receivables, right? Pooling of all receivables into a marketable paper, and that paper is put into the market and sold. That's one of the instruments. The second instrument is conversion of loans. All the loans put into a package and pooling all the assets in package and convert that package into a marketable paper document and sell in the market. It's called, right? That's what we are going to securitization. The pooling of asset, it diversifies and reduces the risk. Individual risk, diversify the risk of the portfolio. Right? They reduce the risk of the portfolio and diversify the risk to more risk-free areas with additional credit enhancement. It will create an additional asset to make a credit, can produce highly creditworthy instrument to the market. It's called debt securitization. Isolating and efficiently allocating the risk. There's no risk. There's no product without risk. All the products have a inherited risk. Right? So isolate the risk and efficiently allocate the risk and arrange the risk mitigating instrument. It is selling the rights to cash flow from loans, etc. Cash flow and the loans. Selling the rights, not the ownership. But it is right, the authenticity of the instrument will be pooled and sold in a It's what you call in a market. The process involves selection of assets by the organizer. So the organizer will arrange, select asset. What asset can be taken place? For example, if the one bank, we take an example, a bank. In banks asset portfolio, different type of loans are there, and their repayment, what do you call, NPV loans, doubtful loans, regular loans, collateralized loans, unsecured facilities. Likewise, different types of lending products are available in this that balance sheet. So the organizer, the originator, will sort out which product can be easily marketed, which are the types of asset which can be easily marketed. Then packaging of pool of loans and advances, assets package. Put slots, mortgage loans, one slot. Mortgage housing loans, one slot. Then business loans, one slot. Vehicle mortgages, one slot. Then loans against machinery, one slot. Motor vehicle, one slot. Likewise, packaging each pool, all the facilities into one slot. It's a pool, packaging a pool in different loans and advances. Then underwriting by underwriters. Because when you put an instrument to the market, it has to be sold fully. If it cannot be sold, an underwriter has to be arranged. The person who guarantees the sale, if not sold that particular instrument, the underwriter will buy it. Okay. Then assigning of selling of assets to SPV in return for cash. Right? Assigning or selling, there are two different words we are used here. One is assigning. It's called assigning means it's a mortgage. Assigning is a type of a mortgage, we know that. Under the Mortgage Act, Section 106, the assignments of assets are legal position given. So assigning is one, or selling, outright sell. These assets to special purpose vehicle in return for cash. So SP will give cash for either on assignment of that asset or on return of cash. So a special purpose vehicle is an organization, intermediary. The intermediary organization between the originators and the investors. Originator and the investor. There are two parties. Originator who's having the assets. Investor who will buy this asset through an asset, SPV. Conversion of the assets into divisible securities. That's why called all the stocks separately, pool all the stocks separately, and it will be instrument divisible. Divisible means it can be divided into, not all in one basket. It can be divided into a number of small pieces. For example, if you put all the assets together, it could say 1 billion. So that 1 billion you can't put to the market. No one will be buying. So it is divided into, for say, 100,000 slots. 100,000 slots. One pool is 100,000. So that 100,000 or 1 million slots, for example. So you can 1 million slots become 1 billion. It's okay. So 1,000. So they can bake into small slots called divisible slots. Then special purpose vehicle sells them to the investor through a private stock market in return for cash. The SP will sell these products in the market money market, where investors will buy those instruments in the stock market. Investors receive income and return of the capital from the assets over the lifetime of their securities. Now the period is defined, so sometimes this lifetime or period is defined. So during that period, the investment capital and the return will be coming from the securities, right? And lifetime of securities, investor will receive income and return of capital from the assets. So mode of operating, how it is operating. The risk on the securities owned by the investor is minimized as the securities are collateralized by the assets. This is already the term asset backed. Right? The securities owned by the investors is minimized because that is backed by an asset. The difference between the rate of borrowers and the return promised to investors is the servicing fee for the originator and the SPV. So there's a gap between the investors, what amount the investor will pay, and the borrowers charged. The return will be the profit of the servicing charges for the originator and the special purpose vehicle organization. Assets to be securitized by the homogeneous in terms of underlying assets, maturity period, cash flow, profit. That's what I showed you. It should be identical. Mortgage of vehicles, mortgage of stocks, mortgage of other machineries, then housing loans, commercial loans, then students' loans, personal loans, home loans, likewise, different homogeneous product put in one basket and make a whole. That's called securitization process. Right. Before I go to the chart, simply I put it to understand what is this securitization process and desecuritization. Now, we take, for example, a bank, we are having a portfolio, and at the moment, bank is finding difficulty to meet their day-to-day needs or investments, right? The banks are needed investment. For example, today, the banks has to increase their capital. We know that. Banks has to increase their capital by 2023 up to commercial bank up to 20 billion and specialized banks to 7.5 billion. In the current situation in the country, it is not easy to mobilize this capital. Either put the shares into market, there's no, you don't find any new buyers coming to buy market. Last, if you look at in the past, the two share issues were undersubscribed and it has been withdrawn by the banks. Two share issues in the last year was undersubscribed. There's no subscribers for the shares. Second alternative is the holding the profits without distributing the profit, build up the equity. To do that, the banks should be earn huge amount of profits. Central bank, of course, put restriction not to distribute profit everything because from that side, the bank can increase their capital. The next option available for the bank is to go for securitization program. But that also one drawback is there should be a good money market. Pooling of assets. Now, that bank, we say bank having housing mortgages. Banks have lease facilities. Bank has other types of, all the different types of advances, business loans, right? Guarantee loans. Different types of loans are put there in their balance sheet, in their books. Now, either they can sell their assets or assign the assets and get a loan. For example, take the property mortgages. Right? Housing loans, property mortgage. Take one example. Now, the loan is servicing. The properties which are mortgaged to the bank, mortgages are idling asset. Mortgage of assets are idling in the bank balance sheet. Little by little for 20, let's say housing loan given for 15 years. To 15 years, that asset is idling. You can't do anything. Owner cannot sell the property because it is mortgaged to the bank. Owner cannot do any other capital structure change because that's mortgage to the bank. Right? So it is that asset has been just blocked physically. And also documentary also, it is blocked with the mortgage. But now this is the debt securitization meaning is that mortgages, all the mortgages put into one pool and one document and dividable into slots. Right? Say we had that 10 million worth of 100 million worth of assets, mortgages, say 1 million slots. 1 million slots, 100. So each one slot is a security of 1 million security. So that 1 million security is sold in the market for certain value, assigning the backed by the mortgage, backed by the mortgage assets. You know, definitely for 10 years that asset will not be given back to the customer. It is in the bank's constructive custody. The property mortgages where asset is the under bank's legal asset. Under Mortgage Act, Section 2 says, what's a mortgage? Deriving the legal title. The ownership with the customer, legal title with the bank. So bank has the right to use that legal title to sell that to somebody, a third party. That's what we are going to try to do in this securitization. Right? To sell these mortgages in the market as an instrument in the market, and whatever loan receivable from that particular segment, capital as well as interest will be utilized to set off that whatever the customer from the is through the SPV to the investor and set off will be set off. Now this securitization instrument period should be less than the mortgage period, because end of the mortgage period, asset has to be released to the customer, our borrower. By that time, it should be free of income sources. So it has to be settled in before that. So that's how it has been arranged. So the SPV will do that in between as a organization. That's a one product. Second product is without selling, assigning. Now, for example, assignment over for example, what is commonly we use assignment, what type of securities? We take assignments in our life insurance policies. So what the meaning of assigning? It is not, assigning is a type of a mortgage. The right of that life insurance policy is taken over by the bank, by the assignment. Similarly, such as movable receivables from other loans or this housing loan the receivables, without mortgaging the asset, mortgaging the receivables, future receivables, loans and interest, that entire thing put into a pool, and that will be assigned, bought by somebody else, outsider, investor, pay for that, and that will be, the funds are coming, cash flow is coming to the originator, right? So that will be serviced by paying back the whatever received from the loans, installment as well interest to set off that investor's money. It can be either lump sum or part payment as installment, depending on their transaction. Okay, so that is what called this securitization program process. So this is sometimes you may see it little complicated, because how can you do that? How can you do that? It simply says mortgages are remortgaged by the bank for outsider. Mortgages are remortgaged for outsider for an advance. So bank will take funds, example, get funds, get the cash flow from the investors, and bank will pay the loan to the investors. So the security is the mortgages. So whenever, if the bank has defaulted, or finance company, for example, the borrower defaulted, they have the right to seize the what you call all the assigned properties. Okay, that right is there. So mortgage or mortgage, in other words, simple terms. That's called distributization. So this distributization came into scene in somewhere in 1980s. Right, in Sri, where I told earlier, it came there here in Sri Lanka, the distributization, for our loan recoveries. In other countries, especially in even India, there are certain companies who will buy the defaulted companies, defaulted loans. Now, for example, bank having a portfolio of NPA, which is a certain amount of NPA, there's a 1 billion worth of NPA there in the books, right? So it is backed by sometimes collateral, sometimes without collateral. Certain companies are formed in India, they will outright purchase those NPAs. Outright purchase those NPAs, right, non-performing assets, and give the cash to the banks. So they take over the NPA and they do the recovery. They do the recovery. They evaluate the asset value of the asset. Even NPA is asset, no? Non-performing asset, they evaluate what is the asset, what is the collateral value, and they put a price and purchase that asset. Once they purchase these assets, they are the owners of that asset. And finally, what will happen? They will take action, either legal action or other procedures to recover, or take over the assets and sell the assets in the market and try to recover. So that will be one of the methods used for recovery methodology. So that was introduced in Sri Lanka also in 1980s, when but banks did not came forward to sell their NPA to those companies. Those companies such a quoted very low prices. So banks thought that they can recover them sometime, may be possible, may not be possible. Right? And thereafter certain other legal barriers came up. So with that, I think that idea has gone down in Sri Lanka. Because in Sri Lanka, there's a problem with regard to the property mortgages. Did Recovery of Bank Loan Special Provision Act. Recovery of Bank Loan Special Provision Act. It has certain what you call controls or barriers, obstacles for the banks to sell their properties in the public market. Certain conditions are in the act there, and it's not easy. So therefore, what happened? The all recovery programs becoming more and more complex and difficult. Anyway, so this securitization, originally it came Sri Lanka to recover the NPAs. Companies will buy their defaulted facilities from the banks and the financial institutions, and they will recover. They outright purchase from the banks, and they do the recovery. Right? So whatever recovery is for them, anything lost, they have to incur the loss, bear the loss. So that's called securitization process, one of the methods. So the debt securitization, the present context, we have some issues having come about this debt securitization. Let's see what are these issues in Sri Lanka. Now, what is the structure of securitization? Right. The originator is in the top. You find this originator here. Originator who create the what you call the bank. We say bank or financial organization is the originator. He will pool all the his what do you call receivables. Right? So he has that debtors are here. That is the borrowers. The originator is equal bank. Bank's borrowers are there on the other side. So borrowers had given the payments to the originator and supplied the assets. Right? So originator assigned the receivables, that is loan receivables, to the special purpose vehicle. That's another organization, SPV. Right? So special purpose vehicle will give back the cash to originator. So originator will supply the cash to the debtor. Then to the now debtor will make the payment will come back, and it is clear the assignments. And on the other hand, special purpose vehicle issue a note that is called the instrument, that is called securitization instrument. Note means it's an instrument to investor. Investor will buy that instrument and pay cash to the special purpose vehicle. Now, special purpose vehicle, when you receive it, it will give the liquidity support to the originator as well as to the debtor. On the other hand, special purpose vehicle will create credit, enhanced credit, by using this assignment, assign the receivables. So this is the structure of the securitization procedure that's applicable. So the special purpose vehicle is intermediate role. And let's see who are the players what we discussed in this securitization procedure. Originator, the entity making loans to borrowers or having receivables from the customers. Right? Making loans to the borrowers, that is a BC bank. Banks are giving finance institutions who are giving loans to the borrowers. Or having receivable from the customer, that loan receivable from the customers. Right? That's an asset. Asset to the originator. Then the special purpose vehicle, the entity which buys the asset from the originator and packages them into security for further sale. Special purpose vehicle, until they on the borrower buy the assets or get the assignment over the asset from the originator and packages into slots. Let's say 1 million slots or 500,000 slots like that. Saleable item level and start for sale. Investment bank, the body that is responsible for conducting the documentation work. The entire purpose, this procedure has to be documented. That means pooling all the assets into one document, one discount, that's slotting out, and terms and conditions for sale for the assignment of that plots, and what is the role of the investor, role of the originator, role of the SPV, all has to be documented. So investment bank will do the documentation part. And credit rating agency to provide value addition to the security. Credit rating agency will give a rating to the security, that slots which are slotted by the SPV. A rating agency will be giving a rating that stocks are marketable, the marketability of the stocks. So that's a high marketability, giving A rating, or low marketability B rating, C rating, like that. With higher rating, it is easy to sell in the market. The insurance company underwriters provide cover against a redemption risk or investment or under subscription. There are three risks involved in this securitization. One is redemption risk. That means if the end of the period, if we are not renewed, redemption or taken place. So redeemed, then there will be a loss to the investor. So that will be covered by insurance, by the underwriters, to the investor. And under subscription, that also covered under insurance company or the underwriters. One obligors, company that give debt to the other company as a result of borrowing. Data is the obligor. That means the customer. Customer whose asset has been, customer who allows, or the borrower who allows, use his asset as a security to borrow from other bank or other organization by the bank. That's called obligor. Investor is the party who securities are sold, who will be by the securities. So these are the parties involved in the securitization. What is this SPV? It is legal entity created to fulfill the narrow, specific or temporary objectives, that is funding the assets. SPV role is a very narrow role, specific or temporary objectives, funding the assets. SPV will play collecting the assets, put into a pool, we create an instrument and sell in the market for the investors. That is the primary role of SPV. SPV are typically used by companies to isolate the firm from the financial risk and allow their investors to share the risk. Used to companies to isolate the risk, financial risk of the company. Financial risk of the company removed and given for the other investors to share the risk through SPV. SPV, as I told earlier, also is an intermediary role. That means between the originator, that is the bank or those who have the loans, and the investor, the intermediary role in between, and helps in the pooling process. Pooling of all assets according to the structure, according to the product, according to the period, that will be pooled all into one package. Holding of pooled securities as a reciprocity. That means the security exchange, role of the security exchange is done by the SPV. Till it is sold, they will be responsible keeping with their custody. Then bankruptcy, remote transfer. In the case of a bankruptcy, of the company, the transfer is remote. That means the transfer is not taking place with this PV. It is only for the particular customer. Why originators will securitize? Off-balance sheet financing, remove illiquid assets. Now, what is this illiquid assets? Off-balance sheet financing. The entire process is off-balance sheet. It is not actually off-balance sheet means not involved in the main balance sheet. Remove illiquid assets. Now we take into consideration what are these illiquid assets in a bank. The banks which are not creating any income, generating any income. Those are called illiquid assets. What are the major components of illiquid assets? Are fixed assets. Fixed assets are not creating any income. So, having illiquid assets in the balance sheet will deteriorate the ROA position of the bank. High amount of non-performing assets will not generate income, have a very bad impact on the ROA, return on asset of the business. So this is one of the methods can used by the originator to remove these illiquid assets from their books, or take off, either it can be take off or it can be kept as it is and create it as a liquid assets to create some income. That is one of the why you can do with that. And, I got some very to give a simple example to understand. You take a balance sheet of the bank, fixed assets. In that fixed assets, balance sheet in fixed asset, is a properties, land and building. The item land and building depict in the balance sheet, generally it will not create any income. Whenever bank mortgage property, mortgage loan is not settled, bank going for parent. Bank goes for parent. If the parent is not success, if the bank parent was not, most of the 90% of the parents are not success, what will happen? The bank has to purchase the particular asset to transfer the ownership from the borrower to the bank. Bank has to buy. When the bank buys the asset, it shows in the balance sheet under the land and building. So that NPA part of that asset, it is not generating income. That is not, and no provision has been made for NPA because it is not in the loan section. NPA loan, because NPA loan has been cleared. When the NPA loan has been cleared, it is cleared and it has transferred fixed asset. Now it has not. It is there. Now most of the banks try to sell these assets by public auction. They are advertising, calling out tenders to sell these properties. But it is successful. It's not very rare. Therefore, one thing I can propose is, because the banks are liquidity crisis situations are there, bank can pool these assets which have been parried and sold as no buyers. Those properties are there. They can put into the pool and try to create an instrument and put into market and either to sell or this asset or to assign and get a interest on that. Assign and get income, get some money on that. That will release the bank's cash flow problem, liquidity problem. And that will be utilized for off-balance as an off-balance sheet item for recovery to create some income. That is one of the product we can consider the future market practically. Right. The other one is improve the capital structure. Right. Whenever we increase the loan capital, it is a part of the capital. Over a period of time, this will be revolved and generate profits. Right? That investment generate profits, and the profits will be coming to the equity as either by reserves or undivided, undistributed dividends. So the capital structure will increase. So as I mentioned a little while ago, the report on the illiquid assets, we can use this asset to increase the asset to equity, increase of equity. Can increase our equity by going for this originate SPV through the SPV to the securitization. We can increase their capital. So it will help the banks to increase their capital structure to face their future challenges. Then extend the credit pool. The more funds are coming into the bank, more loans can be given. More loans can be given. So extend the credit pool. Funds are coming, sources of funds generated from the underutilized assets. Underutilized assets we are using as this instrument, and which will be used for increase the further lending. Further lending. Increase the further lending. Then it reduces the credit concentration. When concentration on credit that we credit propose NPV, regular check loans, because it's not a loan. It's not like a lending to the borrowers. So it will reduce although it's a credit, external credit, outside the books, right? In our balance sheet, it reduces the weight on the credit. So that means debt equity ratio, loan to capital value, all these things, the ratios can be reduced. It's an instrument of balance sheet item. The risk management by risk transfers. Right? As was mentioned earlier, risk in the asset can be transferred to investors. The investors, if they do well, that risk will automatically reduce. Then avoid interest rate risk. Right? So when you do this type of transaction, there's no loans are not given. Therefore, interest rate risk is not coming up. Then increase the profits. So therefore, the originators, they can go for debt securitization. That's a very good instrument to improve their performance. Then what is the role of special purpose vehicle? And what is the special purpose vehicle and its roles? It is a legal entity created to fulfill the narrow, specific, or temporary objectives, funding the assets. We have discussed earlier. Investor review point. What is the advantages to the investor? The securitization. Advantages to investor. Opportunity to potentially earn higher rate of return. That investor, that this type of for getting these assets, right? Higher rate of return can be expected. Potentially earn higher rate of return than the bank interest rate. Opportunity to invest in a specific pool of high quality credit enhanced assets. They can select depending on the what type of pool they are selecting. For example, if it's a property mortgage pool, then it will enhance the credit. That means mortgage or mortgage, credit can be increased, enhanced, expanded. Then portfolio diversification. From the risk portfolio to low risk portfolio, the investment can be diversified. Then prepayment by borrowers can lessen the earning through interest. When the borrowers start paying their loan installments, their what do you call asset mortgage value will be reducing. So they are losing their interest. That's common for any investment for that matter, it is very common. Right? So if you take a loan, when you pay the loan, the interest earning on the loan will be reduced. That's a simple concept. So that's a disadvantage for investor because he cannot get the same interest throughout his investment. Current interest rate fluctuate which affect the floating rates in asset-backed securities. Currency interest rate. Right? Interest rates on the foreign exchange will affect something. Maintenance obligation of the collateral are not met as given on the prospectus. Collateral are not met as given objectives. What is the collateral given? Property mortgage. So the mortgage is not kept in the same lender. It is used, lender is used that for re-lending somebody else. So the main objective is not maintained. So what are the categories of securitization? Some of already I discussed earlier. The asset-backed security I already discussed with you. Those securities whose income is derived from the pool underlying assets, payment from the car loan, credit card, etc. Right? Mortgage-backed securities. Mortgage loans are purchased from the bank and assembled into pools which become a security. Like what I discussed earlier, the mortgage loans put together. Then credit cards, those backed by corporate bonds, those backed by leverage home loans. Credit debt obligation, corporate bonds, and home-backed loans. Those are some of the instruments that have been categorized as securitization. What can be securitized? All sorts of assets are securitized. Auto loans, vehicle loans, student loans, mortgages, credit card receivables, lease payments, account receivables. Any of this, all these things are assets. All these things are assets, receivables are assets, which can be pooled into one instrument and sold for investors. Benefits of the financial environment is acceptable. This brings the financial market and capital market together and hence increase the power of capital market. This instrument are mostly capital market instrument, long term financing, that is capital market, which increase the capital market performance. The securitization reduces the risk for the creditor, so it will lead the lower cost of funding. The risk of the creditor, so it will lead the lower cost of funding. Creditor risk will reduce, the interest rate will be reduced, so no cost of fund for the getting to the originator. Agency and intermediate cost is reduced. Intermediation cost is reduced. They are directly transaction. The rate of the assets turnover is market increase. HFs, housing finance companies do securitize due to this volume of the resources increases. So normally in India, there are housing finance companies which are giving housing loans. They use this method to increase their capital base for lending. So they put this investment into the market to get more funds. Component risk, liquidity and catastrophe are aggregated and distributed to the market intermediaries, which absorb them and make the market stable. Risk component risk, credit risk, liquidity specifically, are segregated and distributed among the market intermediaries, will be stabilize the market. Okay. So this is what I just want to discuss with you. And I have got something else what I thought better to share with you. This is one of the presentations which have been I got down. I got some one Jessica in Sri Lanka one presentation and trying to get it to the mail, but it's not coming up. It is not in the form of PDF or PowerPoint. So it's unable to come. Anyway, last week there was a question about the processing of syndicate loans. There was a question regarding the processing of syndicate loans and how the steps involved and what are the stages involved. So, but I thought I prepared something for you to discuss today. What are the stages in syndicate loan process? So I upload this one to once I finish it to your system. Also, you can download from the recording. It's available in the recording. Okay. Right. What are the steps involved? Syndicate loans. The first stage of the loan syndication process is the pre-mandate stage. It's initiated by the borrower. Pre-mandate means before the loan is granted, the request for a facility. The customer or the prospective borrower who will meet a banker, corporate customer, bank, large bank, and he will forward this proposal. Now that bank, we call arrangement bank, agent bank, or lead bank. He will go through the proposal and try to evaluate before start anything. That's called pre-mandate stage. Right? That means before the grant the facility, background, normally we do a credit appraisal. Any credit loan, any commercial loan, we do a credit appraisal. So this is what we call pre-mandate stage. In this credit appraisal, the stage involves a borrower in a liaison with a single lender inviting competitor bids from multiple lenders. The borrower has to mandate to the lead bank. Right? That borrower has to give the mandate that with application to the lead bank. To lead bank will go through before it accepted. Right? After the lead lender has been chosen, they will start the appraisal process. Now, what is this appraisal process? So any loan facility, any credit facility, we have specifically commercial and facility. There are three stages. Three stages from this syndicate process, normal loan. There are three stages. First stage is identify the customer. Identify the customer, customer background and his business and his involvement. Number one is customer background. Number two is the business evaluation. Business evaluation includes financial evaluation, non-financial evaluation. Financial evaluation, non-financial evaluation. Thirdly, collateral evaluation. Right? Collateral evaluation. So there are three basic things. Appraisals has to be carried out for any credit facility for that matter. Not only corporate, even for any lending issue, any business lending, first identify the customer, second customer's business and his external financial, external and non-financial and collateral. Right? And there are collateral evaluation. Right? The next step will be recovery process that will not be there at the time of credit appraisal. So what is this customer appraisal? That is the customer's background. Who is the customer? Who is the borrower? Who is the intended borrower? What is his background? His personal ability of the customer. Now if this is a corporate customer, there are two components. The promoter's background and the business background. Promoter's background and the business background. There's a guideline for us in Sri Lanka. It is specified in the Companies Act. The Companies Act called corporate governance. In other words, a due diligence. Corporate governance gives the character. What type of a character of the borrower? The company's director board, what are the qualities should be there? It is there in the specifically legally mentioned in the document in the Companies Act. So as banker, we have to compare with this requirement whether the borrower has these qualities. Right? As a borrowers, normally in credit evaluation we go for 5 C's analysis, sympatics analysis, then the other types of different type of analysis, different books we are getting different analysis types are there. All this first thing is identify the customer, his behavior. The most important component is the credit worthiness of the borrower. Whether the purpose of borrowing is legitimate, whether customer have the repayment ability, number one, and need, customer's credit need has to be evaluated. Since it is a large corporate borrower, the risk is very high. So the lead bank has to first process, do this appraisal clearly, whether we can accept the customer to consider this facility or not. Basically, is the project viability has to be developed. Then, if it's a new customer, you don't have the financial backgrounds. Therefore, we have to create future cash flow of the business. The lead bank has to develop future cash flow of the business and see how the cash flow is and the projected balance sheet, projected P&L, and try to evaluate and see whether the project is viable. And thirdly, the viability of the investment. Sorry. The viability of the investment we analyze using certain techniques, payback method, NPV, discounted cash flows. Right? Likewise, the different techniques we use to find out with the customer having a good financial background. Future cash flow is determined if the customer's project is viable. Secondly, non-financial analysis. Non-financial analysis involves, there are three major components. Number one is industry analysis. Secondly, customers market analysis, industry and market analysis, technical analysis, and other environmental factors. So basically, industrial analysis consists of whether the business going to start or whether the loan is going to be invested is a long-term, the benefits or long-term viability of that project. The industry is viable. Okay, so we were discussing about a credit appraisal component of a business loan, corporate lending specifically, the industry. What is the industry of the business? What is the present position of the industry? Who are the competitors in the industry? What is the market of the industry? Whether this customer can, who is going to be the borrower, intended borrower, how he is going to enter into the market, existing market or a new market. New product, there are four components, new product for a new market, new product for existing market, right? Existing product for existing market, existing product for a new market. So which area is going to be looked into this customer, analyze what is the market share he can absorb and what is his strategy to break into the market. So Michael Porter's 5 forces analysis. Then we are discussing this with the other techniques we use to find out the market position, market penetration, and all this about the market conditions. So Michael Porter's 5 forces analysis will give the competitor analysis, buyer's behavior, seller's behavior, substitute behavior, and the competition, internal rivalry for areas. So that is the non-business analysis, non-financial analysis, the business component. Secondly, second component is very important component. Most of the bankers neglect this area. It's called environmental analysis. External, internal. This involves SWOT analysis and pestle analysis. The political environment, political, social, economic, technology, environment, and ecology, and legal. What are these say environment? How it is been affected? So most of the businesses are failed because the external factor has not been looked in by the bank. So before we start the credit proposal, these areas has to be finalized and see whether all are positive. The political environment is should be positive, and the economical environment is supportive, the legal background and legal obstacle barriers, how to overcome that one, the technology side, technology, how the technology used, and what are the external factors. So those are the primary analyzed, then collateral evaluation. What are the risks involved in this proposal? Risk, market risk, technical risk, management risk, financial risk, right? Other external risk, major risk, and how to mitigate the risk. So that will be the proposed project proposal, which has to be the lead manager or the lead lender or agent has to be go through. Once it is satisfied, then the lead bank will see the needs of the borrower and decide the loan structure, and find out what is the needs. So last session I mentioned you, there are three types of needs: capital structure need, working capital need, and permanent working capital, revolving working capital need. Likewise, structure a facility and decide the loan structure and develop the credit proposal. That is a stage one. Once it is prepared, right, it's ready. That means the loan proposal has to be sold to the other participant. The next stage involves the lender placing the loan disbursement. The lead lender initiates the selling loan at the marketplace, for which it will prepare an information memorandum, term sheet, and legal documentation. So the next step will be the lender that you read back will publish for the distribution of the loan. We invite other participants, other banks to participate, other banks, financial companies who are investors to participate in this lending, this syndicate. In other words, syndicate for the facility. So it's becoming a large facility, no? So it will be the different banks will invite. So for which they have to prepare an information memorandum, right? For general information. Then what are the terms and conditions with the about this proposal with the customer, and what are the legal documentation, right? What are the roles and of the participant? We discussed last week about the roles of the different parties and legal documentation. Once it is prepared, then all the what you call they are found out the participants. Who are the participants? They come for the participation. Then of course they start this negotiation. Right? Each and every participating bank will contribute. They say, I will contribute so much. Other one will say, I will contribute so much. Likewise, different banks will take out the part of the contribution. Then next step will be distributed among any underserved. That means the total loan amount is not contributed by the participant bank. Either lead bank will take over that part. The lead bank normally won't take part in the participating. If that anything not left over, lead bank will take over, or the underwriter will take over. The underwriting bank will take over that part. So once it's arranged, in all the participating men agreed, then comes to the loan, disposal loan. The lead bank will then approach other banks to participate. Once the loan contract is finalized, loan amount is dispersed. Then the loan contract is finalized with the customer. Now, what is the documentation security for the facility? Normally, underlying project, and it is will be taken as a mortgage. Project, and the project what you call structures, buildings, land, everything will be coming under for mortgage. Will take under mortgage. So entire project and the project properties will be taken as a mortgage. Now, if the participant individually grant facilities to the borrower has to what you call execute different documents, different loan documents with a different bank. But problem is you cannot mortgage the entire property for one bank. Then what will happen? The banks have to the borrower has to mortgage, primary mortgage for one bank, secondary mortgage for some other bank, third tertiary mortgage, likewise, different mortgages. Normally, there's a high risk in that mortgages. Therefore, normally banks will not accept secondary or tertiary mortgages because whenever defaulted, first primary mortgage had to get the full legal right. After left anything only secondary, after left anything only goes to third tertiary. Therefore, normally banks will not agreeable for that. Therefore, under syndication, there will be one document called concurrent mortgage bond. One mortgage bond to entire project property, right? And different participant banks have their shares on that property. Their percentage of shares, their percentage will be given there. So only one document, it's called concurrent bond. So all the banks, as well as the customer, sign the loan contract, loan the legal documents, that is the concurrent mortgage bond, and mortgage the property in the name of all the banks. In the name of all the banks, simultaneously, not separately, simultaneously. So all the banks have a similar right. All the banks have a similar right. Therefore, if any one bank want to, for example, one bank has want to get released from this participation, so that bank can come out on the participation. Either that bank can sell his participation to other bank, or other banks will share the sometimes. Most of the other banks will take over that portion and release this particular bank. In any case of a default, legal default, what will happen? Each and every bank, participating bank, have the individual right to file action against the borrower. It is not collectively, like, although the concurrent bond is signed collectively, legal action can be taken individually by each and every participating banks. That is what you call the most important factor in this documentation part. Although there is only one document signed and going forward, but when it comes to default case, all the banks have the individual rights. Individual rights. Okay, right. Then once a loan is released and amount is distributed according to the schedule, the stage 3 comes the what you call recovery management part. Third stage is the recovery management part. The final stage is the post-closure stage, which involves monitoring through an escrow account. Escrow account is nothing but the account in which the borrower will deposit the account, but borrower will deposit the revenue. That means the separate account will be opened by the lead bank called escrow account, where all the loan payment, repayment by the borrower will be credited to that account, escrow account. Right? So the monitoring through means that the lead bank will monitor whether the borrower will going through according to the contract. Monitoring the contract is followed by the customer. Any deviation, here the lead bank will take the action, right? And put the customer in initial track, and all the collections comes to the lead bank's account, total amount, full amount, right? Because it's the revenue. It's the agent's responsibility to ensure that the repayment of loan is a top priority, and payments is done before making payments to any other parties. So agent responsible see that all the loan installments have been regularly credited to the account as a top priority before making payments to any other parties. So no part payment will be given to the participant banks, at one stage, participant banks will be paid their installments of their investment installment uh, collected from the customer and distributed among the participant banks. Right? In the post-closure stage, it is the job of the agent to manage the operating and running of the loan facility on a regular basis. So you would have seen the responsibility of the this what you call syndicate loans is based on the role of the lead bank. That's why lead bank will get a commission for that. Lead bank get a commission over that to do this job. Similarly, each and every participant bank can do their own monitoring. They can do own monitoring. They can carry out inspection of the borrower's premises. That the right and given to all the participating banks. Right? Till this loan is paid in full. So the risk in this syndicate facilities is, if it's defaulted, all the bank has to bear the loss. And legal action has to be taken by the lead bank along with the other bank to whatever mortgage to the property mortgage to the bank will be foreclosure and try to recover whatever amount and distribute among the participant banks. That's how this syndicate loans are in operation. Okay, right. So I put some this new slides. Of course, it cannot be shown this in a different mode. That is how that in operation in Sri Lanka. Now, before I wind up, right, I get back to this SPVs and special purpose vehicle, that part. Right. Now we are talking about pooling of asset-backed securities and pooling of securities and SPV and other things about as a new thing. What is the new one? Scavenger. What is scavenger? What does our government try to do? All are interested in that now, today's current environment. What is this scavenger and how? What is this government try to do with this system? Now you will observe what we discussed that regarding this asset-backed securities. What the government try to do is trying to use this special purpose vehicle to mobilize funds. The government is trying to utilize the valuable assets in the Colombo city as well as outside. And I don't know what the term is used as development. And what type of a development is not specifically mentioned there. But one thing is very clear. The scavenger UD has developed a company, it's a SPV, where government valuable properties have been pooled to that company and that company will find out investors, most probably selling of this asset. Now we discussed about the mortgage assets in the bank. Now this is something different, but same principle. The government assets, valuable assets, pool and put into a paper instrument and sold in the market. Sold in the market. And government will get money for their budget deficit, I suppose. Okay, so now the mode of operandi here, same as what we discussed in the asset securitization, right? The assets which are not underutilized, because assets are there, you have to get more benefit from that, either it has to be sold to somebody or assigned to somebody and get some funds. So that's what the government try to do now under this principle. The company have been formed by the UDA. All valuable assets in Colombo City, like General Post Office, then York Street building, the back of Ceylon former building, then police headquarters, Gafu building. Right? All these properties put into a pool and create a paper document, and document will be sold in the has to be sold in the security exchange. So those who want to invest in that, they can buy this debt securities, right? Mortgage securities and give the money to the business. So the government will get the money and invest that money in developing those buildings as a commercial buildings. Still not clear certain areas because the principle is same, but who is going to finance? It is the instruments are put into the security exchange and sold. Anybody can buy. It is not clear now how it's going to do it. But the same principle that we discussed is used for getting finance. It may be long-term assignments of these buildings for development purposes. So people who have money locally or abroad, they can buy these properties. Then they can put up the multi-story buildings and earn their profits. So still not clear about that part. So this is the principle what the government talking about. There are a lot of intermediary blanks. So we'll have to wait and see how it is going to be put in the operations. But the principle is same. This is called asset securitization. Idling assets, pooled and making a money market instrument, and that instrument will be sold to the investors. That is the principle behind this. Okay. So we have some practical exposures can be seen in the current our environment. So time to come more and more these things can be seen. Even within our financial the organization sectors itself, there may be some sort of this type of pooling of assets and putting to market and getting funds, that type of things can be seen in the future. So we can wait and see. Okay, thank you very much. Any questions? Any clarifications?
Sir, so in securitization, the borrower who pays to investor or the bank.
I didn't follow you.
In the securitization,
Yeah,
the borrower
yeah,
pays to when he repays the money loan to whom
yeah.
he pays?
He pays to the bank.
Bank.
Yeah, he pays his loan as agreed to the bank. Bank in turn will pay that to the investor.
Okay.
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 So the end of the period, that's what I told before, that loan period, the SPV has to be paid in full. Sorry, this ABS, asset backed security, has to be paid in full. Then only the property can be released to the borrower.
Okay, sir.
Okay. Any other questions?
Sir, this securitization is allowed in Sri Lanka?
Oh yes, of course. Since 1980, we were trying to do this.
Since there's no market, we cannot do that. This is the thing.
That's the problem. The thing the most get popular because due to the external problems in the country, we could not develop a good financial market. Very, very close market we are having at the moment. Yes, any questions? Anything about venture capital? Have you understood completely about venture capital, how it operates? Okay. Now, to summarize what we discussed once again, we discussed different products in the corporate market for finance to the corporate sector, customers. We discussed in banking products as well as non-banking products, like a financial intermediary product, disintermediary product. So we discussed about the uh, large corporate loans like syndicate loans and asset-backed securities are mostly uh, intermediary sector loans. Then all other things are what we discuss is financial non-intermediate, and that is called disintermediary facilities, commercial papers, corporate bonds, then venture capital, securitization. All these are disintermediary products. Then we got discussed specifically disintermediary product. There are two types. One is short-term facilities and medium and long-term facilities. What are short-term facilities we discussed? That is the basically short-term facilities were, yeah, commercial paper. Commercial paper is a 3 to 240 days or maximum 1 year. That is short-term working capital financing disintermediary product. Even corporate bonds also can be used short term for 1 year period uh, as a short term financing. All other facilities are long term finance, long and medium term finance. So depending on the needs of the customer, we can identify the needs that the customer can go for a type of a product. So normally banks are not promoting disintermediary products because it is banks are losing when they develop these products in the market. That's what mostly the banks. But we have to understand that we are indirectly being supported by these products. We are not directly involved in lending, but indirectly we are getting funds to our accounts that we can lend. So that's the advantage in these things for the banking sector. Okay, right. Thank you very much. Good night.